Welcome back. You're watching First Trades, and let's look at what's happening in the market. It's absolutely flat, but there's an expiry underway on the NSE options market there. The Nifty is down flat in today's trade, and there's an open interest up nearly 1.41% in the July series for Nifty there, which basically indicates some shorts getting added at this point. If you look at the Nifty Bank is also flat today. There's an open interest build up happening of 1.81%. Look at in the constituents, you're going to see some shorts getting built for many of the private sector banks. HDFC Bank, ICCI is seeing short build up happening. There's a short build up happening for Bank of Baroda. Interestingly, Kotak Bank, PNB, IndusInd and Axis are seeing some long build up in today's trade. Put and call action for next week's monthly expiry. We're seeing 24,200 where a lot of open interest build up is been seeing. 24,300 is also seeing a call open interest action coming in at that point in time. So there is a band which is of 24,000 to 24,500. That's the narrow band, 500 point band where the index is going to trade, and that's what the distribution chart also indicates at this point. Currently there is the open interests are even at 24,200 levels as we speak. Future gainers include stocks like IndusInd Bank, Nuvama, Manappuram, all seeing some long build up. Nuvama is seeing a short covering, and then IndusInd Bank is up 3% in today's trade. Future losers include Dixon, Kalyan, where there's long unwind. PTM is seeing a short build up happening there as well. Open interest gainers include stocks like PTM, Amber, and L&T Finance. In the losing pack, you have stocks like Nuvama, short covering seeing there. Sona BLW is seeing a short covering, and SRF is seeing a short covering. But the most active option call strike is UltraTech 12,000 July call. The unwind of 66,000 contracts there, seen the premium up 78 to 241 there. The stock hovering around 12,131 levels there. But in the put side, you have stocks like HDFC Bank 730 July put, where the open interest is up nearly 9.62 lakh contracts, and the stock hovering around 769, 770 levels at this point in time. So the market is absolutely flat. You're going to see some kind of activity coming in the second half when the expiry comes in, and that's when we're going to see volatility coming back into some of the banking stocks as well.
Right, okay, that's the picture right now in trade. But let's pick it up forward. Lots more earnings to digest. We've got Kush Gupta, the Global Head Professional Services at Hexaware, joining in on the show right now. Kush, great to have you today on ET Now. What exactly changes for Hexaware after this partnership that you've actually gone into, and why does Factory AI and no other solution? Why this choice?
We are incredibly excited about our partnership with Factory AI. We saw firsthand the power of Factory platform at one of our strategic clients. What we saw was we could develop large-scale greenfield application in few weeks that would have taken us few years if done through traditional SDLC. When we started evaluating Factory AI, there were three important parameters that we considered for our partnership. The first one was the highest quality of code output should be there. Second one was the ability of non-developers to leverage AI. The third one was a flexible ecosystem through which you can choose the model because of the different kind of clients we had. So what we saw was this particular platform was able to help us differentiate in all of these three things because, hey, nowadays, everybody has got higher productivity, but the quality is equally important. It is equally important to do automation testing. And all of this was something that Factory AI was able to offer us. On the first part, how does this dramatically change the game for Hexaware? Now we've got thought leadership in agent-driven software development. We are able to develop a lot of greenfield application as well as modernize a lot of legacy applications with considerably high speed. And we are able to give clients business outcomes with a lot of flexibility.
And when you say agent native development, how is that materially different from using AI coding assistants like GitHub Copilot?
Yeah, basically two or three things. The biggest advantage that we saw was this was able to create a code map. So basically, if there is, let's say, any code change that happens on 50th line, Droid was able to understand that, hey, this code change could have impacted the 200th line of the code, etc., etc. So because of this mind map and some of the other tools that it has that can integrate very easily in DevOps as well as automation testing, we saw this to be a clear-cut differentiator compared to the other tools that you mentioned. Also, it integrated very well in our coding environment. So we are the customer zero. And we thought that the productivity and the code quality that it offered in some of building of our own platforms like Agentverse was definitely industry changing parameter.
Do you expect the biggest impact to be faster project execution, better margins, or ability to take more work with the same workforce?
Yeah, actually, if you look at the traditional IT services model was based on billable hours, right? What we are saying is that if these droids automate the software development process 5x to whatever number, we are definitely on the verge of going into a true outcome-based model, right? So client don't need to buy hours from Hexaware. They will actually buy completed modernization, zero tech debt, and shift features, which is going to be a game changer for us in terms of margins, in terms of scaling our capacity, and also in terms of delivering 2x, 3x migrations in a fraction of time.
Right. And how are clients responding today? Are they actively asking for agentic AI capabilities, or is this still a market education exercise?
So the fate of the IT environment today is that there is a lot of SaaS bloat. Our target segment is billion-dollar enterprises. In those enterprises, there are anywhere between 200 to 800 SaaS platforms, and 50% of them have overlapping features. What it means is, these are, SaaS platforms that can be replaced without any significant effort. So the clients are looking at a licensing opportunity that exists by eliminating 50% of the cost, which could easily anywhere be 30 to 50 million for a billion-dollar enterprises, right? So elimination of these licenses would require to build this application in-house at a very fast pace, right? That's where they are demanding for platforms like Factory AI that can build them secure, reliable, applications that can be done in few months rather than few years. So that's a real opportunity for us. Hexaware has already launched a new service offering called Zero License, which is focused on exactly that opportunity. And Factory AI actually fits in pretty well in that narration for us.
Right, and Wipro has already partnered with Factory. What differentiates Hexaware's implementation and approach?
Yeah, so what we are doing is we are not just taking Factory AI to the clients as a platform, right? We are building applications, domain-driven applications on top of Factory AI. And a lot of our platforms like Agentverse, which are technology benchmarking platforms for agent-driven development, are based on Factory AI. So we are not taking Factory AI as a vanilla platform for our clients, but we are embedding a lot of IPs, domain within Factory AI and taking it to the market. And that's how we are differentiated compared to the other competitors which are there in the market.
Right. Great to be speaking with you. Thank you so much, Kush, for your time today. Let's move on. Let's talk about Ashok Leyland, which expects the commercial vehicle industry to now grow 5 to 6% in 2026, backed by monsoon and positive consumer sentiment, also improving demand. In fact, the company says that construction activity and LCV demand remains strong, while it will absorb recent cost increases instead of passing them on to the customers.
I would say that air suspension trucks are another chapter in the AL journey, and we are known for our innovation, and happy to say that we have launched our air suspension trucks, which are first in the industry, and we have launched these trucks with 3 configurations, one in 45-ton GVW, 46-ton GVW, and 49-ton GVW. The advantage of these trucks is some of the trucks offer 4-ton extra payload, and when you convert that 4-ton extra payload into money, it is almost 6 lakh or 5 lakh rupees per year, and almost 30 lakhs for 6 years. That's a finance tenure for any customer. So it's a huge advantage for our customers, and I feel that this is going to change the way this segment is growing. Okay. Probably it will pick up the speed also. And of course, while creating these trucks, we have added new features like automatic traction control, IVAC, which will kind of ensure the mileage for these vehicles. And of course, we have worked on the suspension also, right, to ensure that tire life is maintained. See, for any customer, tire life and the fuel mileage, these are the 2 major costs, and we have tried to address both in these trucks.
Absolutely. So you mentioned about a very interesting point related to fuel mileage, and we'll touch upon that in just a bit from now. But give us an understanding of the pricing strategy that you've kept, and what are the sales expectations? Are there any concerns with respect to, inflation inching up, the impact of El Nino?
And if you had asked me this question probably a month back, I would have said yes, there was some concern. But of late, I think all of us are aware that monsoon has progressed well. And when we talk to customers, when we look, overall customer sentiments are positive. So yeah, we are seeing a good interest in terms of trucks, and fingers crossed. I think we seem to be heading for a year which is going to be better than last year.
Okay, so when you say that the year is going to be better than last year, give us a sense of the kind of sales expectations that you have from the festive season. And secondly, sir, I also want to touch upon the fact that inside in your presentation you stated that there's going to be a bevy of launches in the remaining of the year. Could you throw some light on that as well?
I would not like to talk about our future launches, but I would say that definitely, last year TIV actually reached its peak. Previous peak was in 2018-19 when we industry touched 4,14,000. We almost touched 4,25,000. I'm quite confident that this year we should be doing better than last year's peak also. So our expectation is lower single digit, maybe 5 to 6% growth is expected from the industry.
Right. So let me also sort of speak about the sales number for the April to June quarter this year versus last year. In fact, if we look at the SIAM data, it suggests that there's been a sort of 20% growth in the LCV segment this year versus last year. But one would have expected some sort of slump on account of the West Asia war. Is that something that you've not seen at all as far as demand is concerned?
See, market saw this momentum coming in post-GST reduction. It started from October. Right. And I think that momentum is continuing, especially for LCV and ICV range of trucks. We saw some blip during this war in long haulage trucks. But in June, we saw a good pickup once, things were settling down, and especially the crude prices were settling. So I think overall market has been responding positively to the overall growth story of India, and we are confident that this year is going to be better than last year.
Okay, so there are not going to be any concerns emanating from West Asia?
Yeah, we don't see any concern, and we expect even quarter 2 be better than last year quarter 2.
So when you say that you're going to be seeing a better quarter 2 versus last year, where do you see demand coming from? Which segments?
We see demand coming from, as I mentioned, ICV range of trucks, which is up to 19 ton. Construction is doing very well, and now we expect multi-axle trucks to also pick up. So I think other than bus, which declined in quarter one, almost all segments are going to fire.
All right, so that's Ashok Leyland from one automaker to another. Bajaj Auto expected to come out with numbers for Q1 FY27 today. Good uptake is what the street is penciling in revenue and profit YOY. Are we with what to expect?
So Bajaj Auto is going to come out with its Q1 FY27 results. So let's have a look at what we are expecting. We are expecting the revenues to increase by around 35% on a yearly basis, coming in at around 16,960 crore rupees, with EBITDA seeing a flattish growth on a quarterly basis at 3,400 crore rupees, but the EBITDA margins are contracting by 70 bips sequentially and coming in at 20.1%. The profit is expected to come in at around 2,760 crore rupees. What are the factors at play for these results? We have seen that the export growth has been the major trigger and the positive development for the company, wherein the two-wheeler and three-wheeler exports have outpaced the domestic demand. The domestic demand has seen a modest growth over the quarter gone by. So what is the cause for the growth in the revenue? And that is the top line. So that the factors at play for the revenue growth are better volumes, better realizations, the price hikes that the company have taken, and the favorable currency movement that is working in favor of the company. The margins are likely to see an impact because of the commodity cost pressure, but the forex exposure that the company has is likely to offset the impact. So healthy earnings growth is expected, but what will be in focus is the margin impact. So some of the key factors to look out for in the Q1 FY27 results will be the demand outlook as guided by the management for both the domestic and international markets, the kind of margin impact that actually comes in because of the commodity cost pressure, and the subsequent price hikes that the company takes to offset this margin impact. So these will be the key things to look out for in the Q1 FY27 results.
Thanks, Avi, for that preview on Bajaj Auto. So strong set of numbers led by exports expected for Bajaj. But moving on to the big listing of the day, SBI Fund Management. SBI Fund made a positive stock market debut, listing at around 7% premium to the issue price. The chairman of State Bank of India, C.S. Shetty, called it the most successful IPO of 2026, saying that listing was a milestone for the entire SBI group and reflected the contribution to India's financial inclusion.
Your trust is the foundation upon which this institution has been built. As the listing bell rings today, we celebrate much more than the listing of a company. We celebrate the evolution of India's mutual fund industry, the confidence of millions of investors, and the enduring power of trusted financial institutions in nation building. For generations, State Bank of India has earned the privilege of being the banker to every Indian. Today, SBI Funds begins a new chapter with the same purpose, values, and commitments, as Debashish mentioned, to strive to become the asset manager to every Indian. This is the trust we seek to earn and the legacy we are determined to build.
All right, and then there's UltraTech. Struck a confident tone on the Q1 FY27 earnings con call that came through. Management said cement prices have improved, EBITDA per ton remains on track to reach 1,400 rupees by Q4 FY28. Growth capex will continue to be funded through internal accruals. And Ashesha here with our comments.
Well, yes, after reporting strong set of numbers for the first quarter, the management commentary from UltraTech Cement has also continued to remain very positive. Let's start with the demand environment, and the management continues to remain very optimistic. In fact, they said that the industry grew at 7 to 8% in the first quarter, but they remain confident of double-digit volume growth for the rest of FY27. As far as pricing is concerned, they say that yes, prices did improve in the first quarter of FY27. On the back of monsoon, we will see some bit of pricing impact over the next few months, but it is likely to improve further in the second half of FY27, and the management believes that if demand remains healthy, even if raw material prices decline, they will not go ahead and lower their cement prices. So that is another positive. Meanwhile, as far as capacity expansion plans are concerned, they aim to increase their capacity to 240 MTPA by the end of FY28, and they've already started working on their capacity expansion beyond 240 MTPA, and most of their capacity expansion will be funded via internal accruals. Meanwhile, as far as costs are concerned, they did rise in the first quarter. They are expected to rise further in the second quarter, but the management believes that the cost is likely to decline in the second half of FY27, so that is another positive. Meanwhile, as far as the wires and cables business is concerned, they're all set to launch it in the third quarter of FY27. Citi, meanwhile, has come out with a report. They are maintaining their buy stance with a target price of 14,750. They say that the stock trades at $160 EV per ton versus its historical peak of $200 per ton, and they are increasing their EBITDA estimates for the next 3 years between 2 to 4%. Goldman Sachs has maintained its buy stance, but they have increased their target price to 13,500 from 13,160, where they say that they've also gone ahead and increased their EBITDA estimates for FY27. So clearly, management commentary is positive. Brokerage houses too have given a thumbs up. The stock continues to remain in focus today.
All right, with that, thank you so much, Ashesha, for that. With that, completely timed out on this edition of First Trades from Sajid, Aisha, myself, everyone who puts this show together. Thanks so much for watching. Stay with us here on ET Now. More action.
Hi there, good morning. You're watching Midcap Masala on ET Now. I am Snehi Shah and with me is Meryl D'Souza, and you're catching us live from the Suzlon studio here at ET Now. This is a show where we're going to be diving deeper into the broader end of the market, give you a better sense on what's happening in the market as we speak. Now, we've opened absolutely flat for the market. We continue to be there. Let's pull up the charts and see what's happening with the Nifty right now, and more importantly, what is the status of the broader end of the market as we speak. Of course, some outliers on the back of earnings, brokerage reactions to those earnings, some upgrades coming in as well this morning. So we've seen lots of stock action coming in both at the index level and from the broader end of the market. For the Nifty, we continue to be lower by about 0.2% and just around that 24,200 mark. But once again, shifting focus to the broader end, it's the mid-cap and small-cap indexes both doing well, with an uptick of 0.2% in the green. Shifting focus then, let's take you through some of the top stock buzzers from the broader end. Let's start by talking about Ana Housing. Big spike up coming in that stock this morning. 15.25% higher is what that stock is. And the stock is surging in trade after converting 224 units worth 372 odd crore rupees in the first phase of its premium residential project, reflecting strong demand at launch. Now, this conversion covers an area of approximately 4.8 lakh square feet and represents a significant portion of the total inventory at the site. And on the back of this positive news flow, the stock is up more than 15%.
Also in focus today is Karur Vyasa Bank continuing to surge in trade after reporting a strong set of earnings yesterday. Brokerages like ICICI Securities and Axis Capital have continued to be bullish on the stock, with Antique even upgrading the stock to a buy from a previously hold rating that they had given, and they've also hiked target price to 365 rupees.
And another buzzer today is Canada HSBC Life Insurance. The company reported a strong quarter 1 with expansion in APE, VNB and the VNB margin, driven by a better product mix and healthy growth in the individual business. Management remains optimistic on the second half of this financial year, expecting continued double-digit growth in protection and higher contribution from alternate distribution channels over the medium term.
On the flip side, transformers and rectifiers is under pressure today after reporting a muted set of first quarter numbers. Revenue grew 8% for the company on a year-on-year basis, but growth was impacted by a lower capacity utilization due to the company's plant expansion. They did, however, report strong order inflows and a record order book while reiterating FY27's growth guidance.
And lastly, also watch out for Emcure Pharma. That one is in focus today after its semaglutide drug Poviztra has received approval in India to treat a type of fatty liver disease. It is now the first and only GLP-1 therapy approved for this indication in India. Positive news for this company, and the stock is higher by about 1.25% as we speak.
And another set of stock and another stock that we also have in focus today is Rallis India. The company reported quite a strong set of first quarter numbers. Revenue grew 7% on a year-on-year basis.
PAT is up 30% on a year-on-year basis, and EBITDA, that is the headline number over here, EBITDA has grown at a 23% with margins recording a 300 basis point gap up. We have on board with us Dr. Gyanendra Shukla, MD and CEO of Rallis, to break down these numbers for us. A very good morning, Mr. Shukla. Thank you for joining us here on ET Now. You've clocked a record first quarter EBITDA performance with 18.1% margin this time around, and this was despite the driest 12 years June, as well as delayed sowing that we've seen in the past quarter. Can you tell us what really drove this performance to you, and given the strong start, are you now even more confident on margins for the full year compared to your earlier guidance of stable to soft quarter?
So thank you very much for having me on the call. I think our quarter one is really driven by strong performance in seed as well as domestic crop protection business. We had a combination of both volume as well as price growth. Now, as far as agriculture is concerned, I think agriculture is happening. It is the pace at which probably it matters. So from that perspective, I would say, look, we should, I mean, while there is a concern on agriculture, but at the same time, we also have to keep in mind that once farmers plant the crop, and if this concern on agriculture, low production continues, commodity prices will spike up, and that gives an opportunity for companies to continue to grow. So it's a mixed thing. I think it's very difficult to put a point on finger on the future. Rains have recovered. And from my experience, farmers never leave their fields fallow. So they will plant something, and depending on the crop and pest situation, they will use some product. It might be just shifting of numbers from quarter to quarter, but based on it's really driven by domestic performance and higher margins in our export business.
Understood. Dr. Shukla, hi, this is Nehi also joining in. You did speak of commodity prices and the inflation that we're seeing on that note between 15 and 25%. What is the company's plan and timeline to pass on these costs to the end user? What percentage of price hikes are you going to be taking, and how do you think that is going to be affecting your realizations?
Yeah, so I think cost is a real. As war started, cost increase for every company is a real, and every company is trying to pass on price increase, but we have taken a more prudent approach. As we know, in the first quarter, our growth is a combination of price as well as volume. More volume, less price. The challenge in the market is when sentiments are not good, and somebody has already built the inventory for the season. We are a very seasonal business, so we have to make sure our volumes are going in the marketplace. You remain the preferred brand. You take a lot of market actions related to promotion, watching the inventory in the areas where there's a demand, being very, very efficient in the marketplace, running various schemes so that you get prioritization and product liquidation as far as product liquidation is concerned.
All right, understood, sir. Now, I also want to talk about your seed business. So the seed business was impacted by delayed sowing as well as a lower cotton acreage, but you're still guiding for mid-teens growth for the full year FY27. Can you tell us how confident are you still about achieving that growth, especially if the monsoon continues to remain uneven?
Yeah, so cotton season is over in the country. We have better clarity on cotton. So cotton probably we see as a more flat business this year, because our focus was primarily North India business, and North India farmers have completely switched out from cotton to crops like rice, where they see more certainty. Even in southern and central part of the country, because cotton is primarily a rain-fed crop, some of the farmers have decided not to plant cotton. They have switched over to more pulses. And the third thing is that there has also been a lot of spread of illegal herbicide-tolerant cotton in the country, which is an approved technology. As a result, cotton as such remains a very challenging crop in the current year. So our focus is really more on growing rice, maize, and millet business, and that has done well.
Understood. And, I just want to come back once again to that cost escalation question that we were talking about. The West Asian conflict is also cited to be another reason why your input costs are going up. Can you just help me understand what is the dependence or the exposure that your raw material basket has to that region?
I think no, you have to understand chemical industry is highly energy dependent, right? So everybody has significant level of dependence on, for example, solvents. So they're all petroleum products. As crude price goes up, all the solvents. So every bottle of crop protection product sold in the country will have some energy and energy dependency, which is based on the petroleum product. As a result, it is all across. So even if something is domestically available, still it is linked to crude. So as a result, I think this is a common theme for everybody. Anybody who's in the agrochemical business will have to pay this price.
Right. Speaking about these global uncertainties, CSM volumes have actually started recovering for you in some products, which is even as global agrochemical pricing, especially coming in from China, remains under pressure. Can you tell us if is this recovery specific to a few certain products, or are you beginning to see a sign of a broader industry turnaround, perhaps?
So CSM, one cannot really generalize it. It depends on the product and relations you have got your partner. So one of the product we used to sell in America, it has come back in the demand. That has done well. We have been able to renew some old contract, and also we have been able to realize higher price, based on the input cost. So it's a combination of things. What has gone down is what we call catalog products. So some of the low margin products we were sending to the overseas market in America, we have decided to prioritize domestic because export became a very uncertain business.
And exports, you've mentioned that. What's the outlook over there? Any timeline? I understand that there is no outlook when it comes to the way things are panning out geopolitically. But are you looking at diversifying your exports? Can you break down your export share for us geographically?
So export consists of primarily two baskets, what we call catalog product as well as CSM. Now, this year CSM product business has done better than the last year. I think the important thing is diversification in agriculture, because we have seen year on year. Last year, business was down in Q2 because of a lot of rain. This year, businesses are facing challenges because of less rain. So diversification in the product category domestically as well as export market. Export market, you do two ways. You keep launching a new product and keep adding new customers. We actually have been aggressively adding customers in the overseas market. Now we have deployed our people in the overseas market. In past, we managed this business, people traveling from India. Now we've started putting people in those markets on the top of to increase our outreach to the customer. And I think it's a combination of things. But these things we have to understand, they take time to evolve. I mean, these are the customers you don't acquire overnight. You keep building relationship, keep showcasing your capabilities, keep demonstrating your ability to produce high quality product at the competitive cost. So I think is a journey we are in, and we feel very positive about it. Every year we add new customers, and as we speak, in next 2 to 3 years we'll be launching 4 new products, as some of our older product probably will be heading towards end of life cycle.
We'll be looking forward to those launches. Dr. Shukla, I just want to understand a little bit more on the margin outlook. This time, after seeing a little bit of a dip in the previous 2 quarters, your margins have once again reached 18%. How sustainable is this going ahead? Can you help us understand what the band could be for margins for the rest of the financial year?
So it's very, very difficult to say what will happen given the uncertainty, but agriculture is a what you call seasonal business. So you cannot equate first quarter number to apply all other quarters. So a lot will depend on how season unfolds, how pest and disease prices unfold. But commodity prices are positive. When commodity prices are positive, some of the negative impact of less area get nullified. So we remain very optimistic at this point of time, cautiously optimistic, I would say, because nobody knows. Rainfalls have recovered very well, and when there's an intermittent rain, it gives opportunity for farmers to go to the field and conduct operation, spray crop protection product to protect their crops. So I don't think I have to be very pessimistic. At the same time, it's very, very difficult to put a number on in it. But we stay committed to the long-term guidance we have given. 2 years ago, when I took over this role, I said, look, we want to improve our margin on a 5-year basis from average 10% to 15%. And I think last year we ended up at 12.8%. So we're on that path on a weighted margin. So long-term goals are intact. We said we want to double our revenue in 5 years. We want to improve our margin on 500 basis points. So we stay committed to that.
Right. And as I understand, you've actually been among the first companies in the industry to take price hikes. How has that improved realizations for you? Or is there a risk of losing market share if competitors hold prices while demand remains soft? This is because I want to know if this is going to help your margins going on in this current year, or if this is going to spill over in the next year. Just your outlook on margins regarding to your price hikes.
So when we did take a price increase in the month of February after war started, I must admit that first 3-4 months, there was no acceptance because there was no demand in the market. Really, April is farmers are harvesting Rabi crop. It's May when they start planting their crop, and when product moves, you start realizing prices are moving. So I say that yes, prices have started moving up in the market, and when cost pressure is on everybody else, we are in inflationary market. People costs will go up, and crude prices go up. Petroleum, diesel prices go up, transportation cost goes up. So I think so far I would say we have been able to take increased price depending the product and category from low single digit to mid single digit. A lot of it is volume, and we want to strike a fine balance. At the end of the day, choice would be that you want to be left with the inventory, or you want to really optimize your market share. So we were trying to find a fine balance. We continue to stay in touch with on a regular basis our field team, distributors, retailers, to really see what is happening on the ground and make swift decisions.
Understood. That sounds good. Dr. Shukla, thank you so much for your time today. Good to be speaking with you, and good luck for the rest of the quarters for this financial year. Looking forward to your launches as well. Thank you so much for your time.
Thank you very much.
Thank you. Okay, viewers, that was the management of Rallis India talking to us about their outlook, the business outlook and the impact rather from the West Asia conflict and the crude volatility. But on that note, it's time to slip into a very short break. On the other side of this break, we'll take the conversation ahead with the management of Rossari Biotech. So stay tuned and we'll be right back. Back with Midcap Masala. You're watching us on ET now, and you're catching us live from the Suzlon studio. Let's get the conversation going ahead. As promised before the break, we'll start interacting with the management of Rossari Biotech. So we've got Mr. Sunil Chari, co-founder and managing director of Rossari Biotech Limited, joining us on the show to try and decode their earnings and, more importantly, what the outlook for the remainder of the financial year is. Mr. Chari, hi, good morning. Thank you for your time. Good to be speaking with you as always. And, before I decode your numbers and get a sense on what the outlook is, I just want to try and understand the outlook that you've shared on the revenue front. Your Q1 numbers show strong growth. Your revenue was up 28% this quarter, but you've maintained your full year growth guidance at just 15%. What's making you cautious about the rest of the year? Are we looking at any sort of quarterly moderation on the top line you're on?
Good morning. The first quarter has been a great quarter for us. New capacities have come on line. Our expansion was, done in the right way. After the IPO, this was the first expansion which we did in the last few quarters. They are now, we will slowly ramp up. The markets look volatile, uncertain, and that is the reason why we are not committing to any figures and committing to a 15% growth. But we are confident that we should do better than what we guide.
Right, Mr. Chari. Meryl D'Souza here, also joining in on this conversation. Speaking further about your numbers, sir, EBITDA margin has come in lower at 11.6%. And you've stated that this is the new baseline and you still expect margins to move above 15%, but over the next couple of years. Can you help us with what's the roadmap to get there? And can you just explain about what saw this margin pressure in the quarter?
So the freight were very, volatile again, and we lost a lot of extra money on freight for contracts which we had already got into. Raw material volatility also played a very big play. And as I said, in the earnings call yesterday, there was one commodity phenol where we lost about 5 crore rupees extra because the incoming material got delayed and we had to buy at higher price materials. But I think 80 crore EBITDA, which is the highest ever EBITDA, 697 crore sale, which is the highest ever sale. And now, as we try to hive off divisions which are low margins or not, getting into fitting into our strategy, the losses in the consumer business is hitting us, and that is where we have about 4.5 crores losses there. That is where we need to do a sale, and this sale will help us also. We are about 250 crores debt, and this should come down substantially in the next 18 months. And the expansion in Saudi Arabia is the pre-operative expenses also are there in the balance sheet. So I think overall the focus on capital allocation, focus on market, focus on areas where we can get higher margins, and having of the subsidiaries which are not doing well. These are key for us to return to the 15% plus margins.
Okay, understood. So that's your roadmap, and we'll be following that very closely. Mr. Chari, let's talk about your business segments. Your home and personal care and that chemical segment, HPPC, still contributes nearly 80% of your revenue. Can you give us a sense in terms of what the product mix, or rather your segment mix, is going to look like going ahead, and what kind of contribution can we expect to see from TSC and the AHN segments over the next few years?
You see, the last financial year, we grew practically 20% plus in all the three segments, and the HPPC continues to grow well. And with our new Saudi Arabian plants, which we are still in the final stages of finalization, we should see HPPC ramp up to 90%. But the animal nutrition, the textile specialty chemicals will continue to grow. We have invested in fiber chemicals, which will pay off, in this year, in the next financial year, in the vitamin premixes, enzyme premixes, and trace minerals. This is something which is there. We have sold our two offices, Unitop and Rossari, and this has helped us, now gain momentum in terms of sales, but also in 4 years, that is our plan, that we double our sales in 4 years, double our profits in 4 years.
Right, Mr. Chari, understood. You mentioned that Saudi Arabia, and I am gathering that this continues to be a strategic priority for the company, but you have only made exploratory investments so far, and you did mention that you're in the final stage. So when do you see yourself committing meaningful capital there? And as investors, what are the milestones or triggers that we need to be watching out for before you take that next step?
We are in the final stages, so we cannot count the chickens till they are hatched. So we would try to do it as early as possible, but it will be definitely in the near future. We will make some announcements once we are ready.
Mr. Chari, just wanted to clarify, you did say doubling of profits for the next 4 years. Is that right? Did I get that correct?
Yes, we are on track and to double our profits in the next 4 years.
Okay, sounds good over there. Let's also talk about your capacities. You've commissioned the new blending facility in Thailand. How quickly do you expect utilization to ramp up? And what kind of revenue contribution are you expecting from Southeast Asia in the next couple of years? And I'm asking this because in India, at least as far as I'm aware, you're not planning any major India capex, right? So can you talk to us about what the overall capex outlook is and what that will do to your capacity?
If you see our exports, they have been highest ever again. We have grown year on year exports. Exports contribute about 24% of our sales. And this is where we want to ramp up, and we want to increase our exports in the near future. If you see, analyze our last year's export, our major exports was to the Americas and the Europe markets. Gulf and the Southeast Asia was comparatively lesser, and there is where we wanted to focus. The Thailand investment is very small. We did about 10-15 crore rupees investment in Thailand, and we do not expect big sales there, but this will help us as a service point, getting into the customers, doing sampling, and also the ROC. Our focus is that we grow from this 14-15% ROC to 20% ROC. All these are steps which we are taking to increase our return on capital employed.
Right, Mr. Chari. Another thing that I want to touch upon is that you've highlighted ethylene oxide availability as a key constraint going up to FY28. Can you help us quantify how much that business is actually holding back on your company today? And just any timeline that you can give based on quantifiable guidance up until FY28 when the situation improves?
See, we did a 15,000 tons expansion in ethylene oxide, consumption for the MDA plant, and I think this will ramp up in the next 3-4 quarters. We are expecting more ethylene oxide from Reliance from December onwards. That is what which we have seen from the internal news from Reliance. And once this comes in, this 15,000 tons extra will add. Now we are running at 100% capacity utilization in ethoxylation, and whatever expansion which we have done in non-EO has contributed to the good sales, which is 28% year-on-year increase in sales. We expect for the year 27-28 to be very strong with our ethoxylation capabilities.
Okay, so you do expect to see improvement by the year FY27 and 28 when it comes to your ethylene oxide situation. Thank you so much, Mr. Chari, for taking out the time to speaking with us today. It was a pleasure to have this conversation.
Thank you so much. Have a nice day.
Yes, of course. And with that, viewers, we're completely timed out on this edition of Midcap Masala. But stay tuned to ET Now for more market updates coming your way.